So a lot of people have been making content calling mutual funds a scam, calling that SIPs into mutual funds, index funds, which are also mutual funds, is a scam, and it is not the way to go for the average person to build, actual wealth. But I wanted to clarify that I think all of these people that are saying these things have their own agendas to sell you something or to make money from you, because mutual funds are far from a scam. I think they are the best thing that has happened to the average investor, and it is the best way to make wealth in equities. So I'll explain how. Right. So let's say you have a mutual fund, and let's compare it with, let's say, buying equities directly. Let's say this is your DMAT account, right? This is a mutual fund, and this is a DMAT account. Now, both of these entities buy shares of, let's say, X company. Let's say it's Reliance, right? And this guy also, through his DMAT account, buys a share. They both hold it for like a quarter and then they sell it. So the mutual fund does not really, pay any taxes or any big expenses on doing this transaction. While for the DMAT account guy, this is a taxable event. This is a very big difference, which leads to, I'll explain this in more detail, that how this affects your returns long term. So on average, 3 to 4% alpha, which is essentially, if let's say the mutual fund is investing in whatever stocks and generating, let's say, 10% returns over the long term. And for you to actually be able to beat this fund, you'll have to get like 13% returns just to make the same money as this fund makes, due to this tax difference, right? I'll explain more how that number came about being. So just to be clear, it is not easy to get a large alpha. Large alpha is like anything above 5-7%, right? You will see guys celebrating that, oh, I beat the market by, through my personal investing, I beat the market by 3-4%, and they're very happy with that. But they're not doing anything meaningful. They should stop investing on their own, I think. They should just, pick a mutual fund and whatever fund they like, and be directly involved in maybe tracking what fund they're buying and how the fund is doing, but not invest in their DMAT account at all if they're not able to get at least 5-7% alpha consistently. So I believe that you have to be a full-time investor to, beat the market or the mutual funds by 5-7%, because even the mutual funds, they are doing it full time with a team, a flow full of people for every sector. They have a team of 40 analysts covering just, let's say, consumer spaces. How do you beat them without giving it all you have? And even then, I'll argue that you cannot beat them very easily, but it is possible, because you don't have any liquidity issues like them. So mutual funds don't have as much opportunity since they have a large scale. But you, on the other hand, as an individual investor, you can buy an SME maybe. You can, and you can invest good money into an SME and make money there as well. But mutual funds on, let's say, large cap investing will probably always beat you. And even if you're able to beat a large cap fund by your own large cap investing by, let's say, 3-4%, that does not have any meaning whatsoever. Also, mutual funds can have a lot of churn, and that does not impact the returns at all. While you, as an individual investor, if you're having a lot of churn, which you will have if you want to generate alpha, because you'll have to stay with the market, right? And the market is not always going to be like only these companies will keep on working. The sectors might shift, whatever might happen. So your churn works against you. So earlier, everything in the economy moved very slowly, and you could basically have held on to companies for a longer time without there being a shift in, let's say, the market sentiment or the earning cycle. But with the pace of change and the pace of disruption and competition in every industry, pretty much, to make large alpha, you'll have to stay with the market, which is changing quickly. You'll have to have a lot of churn, and when there is an environment that you have to have a lot of churn to beat the market, mutual funds have a further advantage, because you, being the guy who invests through the DMAT account, will, the more churn you have, the more returns you lose out on compared to the mutual fund guy. So first, let's just cover the very simple part of dividends. Let's say you're holding 10 securities, and for that, you get like 2 rupees of dividend every year in a mutual fund versus a DMAT account. So the DMAT account and the dividend that gets given to you, that will be taxed at a much higher rate. Firstly, that will be a taxable event of that dividend coming to you from the company. You'll have to pay taxes in the year when the dividends are they accrue basically. Whereas in a mutual fund you can get those dividends reinvested without having a taxable event, and that reinvestment will further compound, and you'll only pay taxes basically when you sell the mutual fund. So regarding capital gains, all the churn that happens in a DMAT account, every time you sell a stock, that's a taxable event, right? uh, but for a mutual fund, that is not a taxable event. So let's say you do all the trading, you make some returns, and this year you lock in some profits. So let's have a situation wherein you have through your DMAT account a capital gain of 500 rupees on whatever holding you have, and out of that 100 is your taxes, right? If the same thing happens, the same companies were held, you did the same thing in a mutual fund. So what happens then is this 100 rupees of taxes you don't pay today. This you can reinvest and keep in the fund basically. And any return that the fund generates the years to come forward, right after that, all of those returns will also be taxed. So all of those returns will also not be taxed at that time. So it is only when you sell the fund that you'll pay tax, and any return you make on the amount of tax you would have otherwise paid, that is basically free money, right? If you compare it to a DMAT account investor, this is free money because those guys have paid taxes. And once you pay taxes, that money is no longer working for you. Whereas in a mutual fund, the tax that you should have otherwise paid, that is also working for you, and any return you make on that, you only pay, let's say, 20% tax on that extra return. So the rest 80% is basically free money. Over time, this generates, it depends on the churn of course, but it generates 3 to 4% alpha on average for a mutual fund, and to beat them is very very hard due to the simple reason of taxation. Also, what is the issue with mutual funds for a small investor, right? If you have a family office of, let's say, 10,000 crores, then I think you can hire a whole analyst team, and it would not cost even 1% of the assets per year to manage these assets. But if you have like 10 lakh rupees, why are you trying to you basically have no chance of ever hiring anyone or ever investing in any technology to help you invest better. So why are you as a small guy saying that okay, mutual funds are not for me? How will I ever make large money? I would actually argue that even these family office guys, they should also be looking at some mutual funds for sure because of the tax benefits. So let's say you have 10 lakh rupees of total assets and you spend just 1 lakh rupees on, let's say, meeting a management, buying some software for investing better. All of those things are like 10% of your, that's like 10% expense ratio. Whereas a large family office can, basically cover all their expenses in like even 0.5% sometimes if it's a large family office. And they can have like 40 people team if it's a very large family office, of course. So I do not know of any way to invest in equities in a better way with more advantages or more, odds in your favor than through a mutual fund. Because if you do know about it, do tell me. I do not like PMSs or small cases a lot. I have a bias against them because of taxation. And the only time that you can look at a PMS or a small case and justify it is when the tax disadvantages are consistently being taken care of. So let's say if you generate a 10% alpha, right? If the Nifty goes up 10% and your fund is going up 20%, so the alpha is 10%. So even after, let's say, a 2% fee that the fund charges, this PMS, for example, and after the added taxes, let's say 2 more percent extra is gone away in taxes, that difference still, the remaining 5-6% alpha is still very, very meaningful. So ideally, 8 to 10% alpha, if you're not able to get these alphas in a PMS or a small case, I don't think there's any point, because you can basically just do the same thing in a mutual fund without filing taxes every year. Because if you hold a fund, which is a PMS, you'll have to file your returns every year. You'll have to maybe hire an accountant or a CA for that. And some people might be thinking that, okay, if this PMS manager is able to do so good that he's able to generate 10% alpha, won't I keep more of that alpha if he does the same investment through a mutual fund structure? The answer to that is of course, but what tends to happen is that if there's a very well performing mutual fund, the assets of that fund rise very, very, very quickly. So PMSs are basically the people who can invest in a PMS. It's very limited, right? Only so much capital can come through the way of a PMS. So since the PMS is at a small AUM, it has more odds of being able to generate this alpha in the first place. So if there's a PMS with, let's say, 1 lakh crore of AUM, and that too in, let's say, the Indian markets, it only invests in the Indian markets, for example. So I think it is very, very unlikely that this PMS will be beating the market after fees and expenses and tax differences. And if you're trying to be an individual investor who is aiming for 15% alpha, something like that, then of course your DMAT account investing that is giving you 15% alpha is way better than any fund in existence. But I think you'll have to work extremely hard for that. Let's say at least 10 hours a day, every day minimum, right? Without that, you cannot even expect such a return. It's actually very unreasonable to expect such a return without ever working full time as an investor, because it cannot be that easy. You're competing with all these people who are doing this full time, and the only advantage you have is that you're the small guy with small capital. So that in itself is not enough if you're making a lot of mistakes that these guys will not be making. So you have to do as good as these guys in terms of not making mistakes, but you can leverage your size that you can get in and get out of positions very quickly, and you can basically use that to generate a lot of alpha, and people have done that. So I'll conclude by saying that for 99% of people, mutual funds is the way to go. And if you're doing it full time and trying to beat the market, uh, I don't think it's reasonable to expect to do it as a side thing, as a side business. It is a full time thing, and you can just basically, if you can tell me any person who did it part time and made big money over a long period, I'll be surprised. And the people who are telling you that mutual funds are a scam, I won't name the people, but we all know that they have a history of promoting products which are extremely risky. They have extreme concentration risk, let's say unlisted shares, right? So there was this guy I remember who was saying that rather than investing in mutual funds, people should get, let's say, Swiggy or unlisted companies IPO shares, and this might work out for people. I'm not saying that this company or these shares which were unlisted back then, they won't do good. But to call mutual funds a scam, even slightly, when you're promoting these things for, of course, for money, right? You'll probably be getting some money from someone. I think it's just very, very unethical. I mean, sell all the courses you want to sell. That is fine, honestly. But why mislead people by saying that mutual funds are not good when you know for sure that for 99% of people, this is the right way to go? So that will be all for today. Thank you.